The Nifty has surrendered the 26,000 mark, but don't let the red index fool you. The retail army is buying the dip, while the institutions are rushing for the exit. Hello, I am Prem and welcome to the post-market roundup of India market bought by news that move markets. The scoreboard looks ugly at first glance. The Nifty 50 shed over 120 points to close at 25,840, while the Bank Nifty lost more than 300 points. But here is the data point that matters most. The India VIX actually dropped over 1.5% to settle near 11. Usually, when the market falls, fear spikes. Today, fear cooled off. This tells us that the sell-off wasn't panic. It was a controlled, calculated correction. The smart money is de-risking ahead of the Federal Reserve meeting, leaving the heavyweights weak. However, the market breadth tells a completely different story. While the giants stumbled, the Nifty SmallCap 100 surged over 1%. This is a classic divergence. Foreign investors and institutions are selling the index, but retail investors and HNIs are aggressively hunting for bargains in the broader market. In terms of sectors, the pain was concentrated in interest rate-sensitive pockets. Nifty Realty crashed 3% and IT shed 1%. The trigger was the US 10-year bond yield spiking to 4.18%. When yields rise, high-beta sectors like realty and high-valuation sectors like IT immediately feel the heat. Capital is rotating out of these rate-sensitive zones and finding shelter in individual stock stories. The stock of the day is undoubtedly Kaynes Technology. After a brutal 4-day losing streak, the stock roared back, surging 9%. The catalyst was a double dose of confidence. Management clarified the accounting concerns raised by the Kotak report, and JP Morgan stepped in with a bullish note, calling it the cheapest stock in Asia Pacific. That combination triggered a massive short-covering rally. Also a brief mention for Indigo. After a relentless 7-day crash, it finally ended in the green, up 0.25%. But be careful. With refunds piling up, this looks more like a dead cat bounce due to selling exhaustion rather than a fundamental turnaround. Globally, the cues are mixed. European markets are split, with the UK's FTSE in the red and Germany's DAX slightly green. However, US Nasdaq futures are trading up nearly 0.2%, attempting to stabilize after yesterday's pullback. Everyone is holding their breath for the Fed policy. Technically, the setup for tomorrow is fragile. The Nifty has decisively closed below the psychological 26,000 level. That mark has now flipped from support to a tough resistance ceiling. The immediate support to watch is 25,700. If the bears manage to drag the index below that, the door opens for a slide down to 25,500. My closing thought is this. We are witnessing a battle between institutional caution and retail optimism. With the VIX low and heavyweights weak, the index might remain dull, but the stock-specific action is heating up. Stick to the small cap stories, but keep your index trades light until the Fed event is out of the way. That is your post-market wrap. Stay disciplined, and I will catch you tomorrow morning.